Hey, Brian, it's Brian. Just as a reminder, everything needs to be by roll call vote. I see that we're recording, and just make sure everyone can hear each other and we're good to go.
Sounds great. Thank you for the reminder.
No problem.
Okay, hi Brian.
Hi.
I only have a few of the videos here, so I'm just gonna go through everyone and see who's here.
Awesome. Thank you, April.
Josh,
Yes, here.
Elizabeth. Is Elizabeth Hannon not here? Okay. Richard.
I'm here, Richard Schnurr.
Hi. Mark.
Last year.
Brian.
Yes, I'm here.
Carla, I heard you.
Yes, I'm here.
And it looks like Elizabeth just joined us as well.
Okay. And then Ron is absent, correct?
Correct.
And I'm here, but I may have to jump off at any time, so sorry.
Okay. Did I miss anyone? Okay, I think I've got everyone.
All right, perfect. Thank you, April. It looks like our first item on the agenda is the investment business from First Breezy. It looks like we've got Aaron and Kevin. Is that correct?
Yep. Morning, everybody.
Morning.
Perfect. Well, we're going to pull this up on the screen here, so just bear with me. Okay, can everyone see my screen?
Yes.
Yeah.
Great. Perfect. All right, Aaron, if you want to go ahead and kick things off, that'll move into the presentation here.
Sure. Yeah. Good morning, everyone. Hopefully you can hear me all right. So yeah, we've got our standard report to present today laid out in the same fashion as before. So I'll run through these items, hit some of the highlights. As always, definitely feel free to stop me at any point if you guys have questions along the way. This meeting's for you guys, so definitely don't hold those questions back as we go through. So looking at the first page, after the title page here, just hit some of the highlights of the portfolio for the quarter. And as we're going to see as we make our way through this report, it was just an excellent quarter as far as returns go, really across the board. So the portfolio finished the year quite nicely, and we'll hit on some of those reasons again as we get into it. But as far as market value, you finished the year at about $42.4 million. I did just check it as of yesterday's close, which we were down a little bit over the last few days. You're still up a little bit for the year, right at about 43 million as we sit here today. So for the quarter, that was a gain of just about 5.6 million. And a lot of that really came in November and December. Those were really the strongest months. So that fourth quarter return was about a little over 15%. And so year to date, like you can see, that was really most of the return for the year. You finished the year up about 18.5%, ahead of the blended benchmark at 17.4. And then, as we always like to quote, the since inception return going all the way back to 1998, you're up about 8.4%, which was a little ahead of the blended benchmark as well, about 70 basis points per year. Now that doesn't sound like much, but when you add that up per year over that many years, when you're talking dollar terms, it's a pretty large number. Next couple bullet points just hit on a few of the highlights as far as the actual fund returns. And on a relative basis, relative to the benchmarks, you guys actually did quite well also. And what we really saw in the fourth quarter was somewhat of a rotation away from the growth stocks kind of leading the market, you know, the more technology focused stocks, into the more value sectors. In fact, Energy and financials were the best performing in the fourth quarter, and that helped some of the value strategies within the portfolio. So for instance, in the U.S. large cap space, the Dodge and Cox fund was up about 21% for the quarter, nicely ahead of its benchmark. And then the best performing fund was the small cap value fund from DFA, up almost 33% just for the quarter. So again, very strong returns, especially from the value side of the market there in the fourth quarter. And then in the international space, great story there. All 4 funds beat their benchmarks. This was the second quarter in a row that happened. And again, best performance came in from the American funds, Euro Pacific. And then finally, the last bullet point there, the fixed income had a nice return as well, up about 1.3% for the quarter, slightly ahead of its benchmark. And for the year, it was up 7%. So again, a really nice return from the bonds as well. So like I said, really across the board, everything was looking pretty good for the fourth quarter and for the entire year. So going to the next page here. Just a quick snapshot of the kind of broad breakdown of the portfolio. We've got those weightings on the left, the policy on the right. For the most part, you're right in line with those policy weights. Maybe a little overweight with the equity index fund. That would primarily be the Vanguard 500 fund that you have, and a little underweight the active funds. But we really don't see much of a concern there. You know, those are fairly interchangeable, but yeah, we don't really see a reason to be concerned at this point with the drift that's happened a little bit. Looking at the next page, this gets into our actual Black Diamond performance report. We just lead off here with some broad commentary. I hit a few of these points already, but I'll maybe hit a few more as we go through this. We also present some of the broad index returns there in the box in the middle, and this is focused primarily on the U.S. market. So like I said, finished the year on a really strong note. Obviously, the big news, and I'm sure all you guys are well aware of this, was the vaccines that came along towards the end of the year. And I think that was somewhat priced into the market, but I think it even turned out to be a little better than expected. And what I mean by that is we now have multiple companies that have had a successful vaccine. So not only did we develop it in record time, but multiple companies were able to achieve that. And then also the efficacy rate of those vaccines was higher than expected. In fact, it was close to 95% for a couple of them. So again, I think a lot of people were expecting, 75% would be pretty good, and they came in much higher than that. So again, I think that was a big relief for investors and for the market, with the thought being that as we get these rolled out, we can maybe start to return to normal once enough people have been vaccinated. But that's still probably looking maybe more towards the second half of the year. But as we sit here today, we're starting to see some of the larger states start to reopen, notably New York and California have announced some of those plans. We're still pretty restricted travel-wise, especially international travel. That's probably going to be the last area I would say that would open up. And like I said, probably towards the second half of this year, I wouldn't be surprised if that starts to happen. In addition to the vaccine, the other big news that helped the markets was obviously the stimulus plan. We got another round of checks that went out, this time just $600. And now you're even seeing talks of additional stimulus as well. So I think, again, that's helping to prop up the market a little bit. One thing we point to, and we've been talking about this for a little bit, is there in the third bullet point. Now that we've had this huge rally, especially on the growth side of the market, you see there looking at the NASDAQ, which mostly is those growth stocks, it was up 45% last year. We're seeing valuations get a little stretched on that side of the market. Things are looking a little expensive. So I would just kind of caution your expectations there. I wouldn't try to extrapolate the performance from 2020 on into 2021. It's going to be hard to repeat that. And we've dialed back our return expectations for the U.S. market, and in particular, the growth side of the market. We're still seeing some okay valuations in some of the sectors. Like I said, like energy and financials, some of the ones that have been hit a little harder are still trading more in line with their averages. But some of those tech names are quite above where they've historically traded. Looking at the next page, this gets us into the international markets. Really the same story there. 2020, all markets just kind of mirrored each other due to the nature of this global pandemic. So we saw a big sell-off there early in the year, and then they rallied back in the fourth quarter, just like our markets did with the vaccine news coming along. So all in all, if you look at the numbers there, things were quite good, especially in the emerging markets. And a lot of that was led by the Chinese stock market, which was really where this all started. They had the heavy clampdowns initially, but then they were able to open back up a little sooner than some of the other economies. And so we've gotten some readings there that they're already showing some nice GDP growth in that economy, which has helped boosted markets there. So we're still seeing some good opportunities there in the international markets. Valuations look a little more reasonable. You can get some better dividend yields. So we're still pretty optimistic that those are maybe poised to continue outperforming the U.S. market as we go over the next several years here, just based on these valuations we're seeing today. And then finally, we hit on the fixed income market. As I already noted, returns were quite good there, really driven by the Fed actions during the year. They drove down interest rates initially during this pandemic to try to ease the concern from it, get the economy going again. They also implemented some pretty large bond buying programs, again, just to get the wheels turning again, if you will, within the bond market. So all those actions taken together, primarily interest rates falling, really helped bond prices last year, and that's kind of what led to these mid to high single-digit returns. Now, again, looking forward, it's going to be really hard to repeat that as we move ahead. In fact, here recently, we've already seen rates start to rise a little bit. The 10-year Treasury bond has gotten back above 1%. We're seeing inflation expectations pick up a little bit. So it's going to, again, those rising rates are now going to act as a headwind for bond prices, and we're going to expect much more muted returns from the bond side of the portfolio. So just something to be aware of. It's kind of the nature of where we're at. There's not a whole lot you can do about it. With rates being really low, you're basically just going to get your coupon and probably not much more at this point. Now, again, obviously, you guys are restricted with your policy requirements, but we do still feel, obviously, those bonds will provide nice protection if for some reason we do get some sort of pullback in the market. So even though the returns are going to be lower, we still think they're an important part of the portfolio and something you still got to have, especially for a balanced allocation. So with that, I know I kind of rattled all that off pretty quickly. Maybe I'll pause there, just see if there's any questions so far from the group.
I do.
All right.
Oh,
yeah, go ahead, Richard.
Hi. I was reading a magazine recently and said that generally when there's a new president, usually the investment gets bitter. I wonder what you think about that.
Yeah, I think looking at those trends, there's probably always a little bit of optimism when the new administration comes in. They want to get off on a good foot. I think that's why you're seeing this administration make a hard push for additional stimulus to make sure, some of these kind of consumer gains that we've made continue. Now, historically, really what we've seen is markets tend to do fairly well no matter what the administration situation is. And in fact, they tend to do a little better when we have kind of split control. Now, granted, now the Democrats have pretty much taken control of Washington, although in the Senate, it's an extremely thin margin that they lead by. So my best guess is we're probably going to have some gridlock as far as major new policies go. I think it's going to be tough to get really anything passed in this environment. And that's actually a good thing for the markets. It makes the playing field a little better known situation. If there's not going to be major, tax changes or healthcare changes or really any other major policy initiative there may be, if it's just kind of status quo, that's actually good for the market. So kind of along the lines of your question, I think what's happened in Washington really shouldn't hinder what's going on with the market or economy in a large way. Obviously, the bigger issue right now is the path that this pandemic takes. If these vaccines can be truly effective, allow us to get open back up, that's really what's going to drive the economy and in turn the stock market, probably more so than what's happened in Washington would be my best guess. So hopefully that kind of answered your question that you had.
Actually, you answered my second question, which was if 10 million people who are not working, but should be able, hopefully, by the time the end of this year or earlier, that should help too. But I think you spoke about that already, so thank you.
Yeah, sure thing.
Yeah.
Aaron,
All
I have
right.
a question. This is Brian Hoff.
Yeah, go ahead.
So I actually have a two-part question. One, as it relates to our fund in the long-term investment plan, and then two is as part of that, we know that we're going to get notified here at some point of our fund asset changeover. How do you feel that we are poised as the economy? Obviously, we can't predict what the marketplace looks like within the next year. How are we currently poised, in your opinion, if we are notified, today, tomorrow, or 6 months from now, as far as that fund transfer and those asset turnovers start to occur? And do you have any opinions of strategy or things that we should be considerate of in the next year here as we find out more details going over to the fire pension investment portfolio?
Yeah, great question. And unfortunately, I'm not sure I'm going to have a great answer for you. And I'll let Kevin weigh in as well, but I haven't really seen any detail as far as what the investments would look like, once the state takes over. And that's going to be the critical thing to know to kind of answer the question that you have. But the assumption I'm working on is that what you have today will essentially be similar to what the state will do, meaning as far as the split between, kind of stocks and bonds or the amount of U.S. stock versus international stock. I'm assuming all those weightings will be somewhat the same. And if that's the case, then the transition really shouldn't be too much of a big deal. You're just essentially going to go from, your U.S. equity investments into their U.S. equity investments. And it really shouldn't cause, much of a shock to the portfolio, if you will. Again, assuming that allocation is going to be the same. But until we know that for sure, it's really hard to answer that question or really kind of prepare for that transition. So I'll pause there. I don't know, Kevin, maybe you've seen any information around that, or if you have any more details there.
Yeah, I'll just echo your comments. I think there's a lot of speculation around it at this point. I don't think there's any kind of firm guidance yet in terms of what that allocation would look like. I initially read something that it would be, more conservative or more balanced. Like right now, overall, I think you guys are about 60-40 when you include the other fixed income assets outside of what we manage. But then I've heard it, it may be a little bit more on the aggressive side. So I've kind of heard a mix of both. So there hasn't really been good guidance yet. I would say just in terms of your positioning until we get there, we feel good about where you're at today, positioning wise. But yeah, like Aaron said, unfortunately, we haven't received guidance yet. It's been pretty quiet, at least from our perspective, since the pandemic hit. So hopefully more to come as things start to get back to somewhat normal so that we can get an idea of what that would look like for you guys and across the state.
Okay, thanks. And just one more follow-up. Is there a way to really put to perspective like the loss of from the transition? Obviously, when we're selling out of one fund to translate those investments to the fund or transpose those investments to the fund, is there a way to get an idea of the loss that's occurred? I guess I'm just trying to paint an overall picture of we've been painted a certain picture that this will benefit funds across the state, and I'm just trying to also keep focus on where we were prior, and then what occurred from the transfer. So is that a possibility, like when that starts to occur?
Well, when we know the date that you have to transfer the funds over, we can provide a performance report as of that date, prior to the transfer. But then the question becomes, are they going to allow you to transfer these in kind? Are they going to have you sell and send the cash, and then they're going to invest it in whatever model they're doing? That's just kind of hard to know because we don't know that amount of detail yet. But in terms of what we can do on our end and control on our end, we can certainly give you a performance report as of the date that, we either have to sell out or have to transfer the assets over. And then whatever period of time that takes, I think just, internally on your end, you can just see, where did the portfolio end? And then, what does it look like when it's in whatever new strategy it's in? And again, that's kind of pure speculation at this point, unfortunately.
Okay, I appreciate that. And sorry, just one more while I've got you.
Sure.
Have you guys had any involvement or ability to become a part of that investment strategy? Has that been restricted? What kind of information? Obviously, I'm sure that you guys have people that are trying to get info on it as well. And do you have many details from the investment side of what was required or excluded you from being those investors?
Aaron, I don't know about you. I have not heard anything on that front. I think, the state will have their, preferred providers. I don't know if they're going to open it up for RFP for people to, be a manager on their platform. It's hard to tell. I mean, honestly, I think they'd probably, if it's, if they have control over it, it'll probably be, more, larger investment managers, kind of global investment managers is what I'm guessing. It's just so hard to know. I mean, if we do get the opportunity to be part of it, we'll certainly like to be, but, again, it's just, we don't have a whole lot of information on even that front, unfortunately. I don't know, Aaron, if you've heard anything different.
I have not, no. And yeah, like Kevin said, we'd want to be a part. Knowing the state of Illinois, though, the cynic in me says you probably got to have some connections to be part of that group. But like Kevin said, we really don't know yet, but we'll try. Yeah, we would certainly love to be. And so we'll just have to kind of wait and see what the requirements are.
Yep.
Sure. Okay. Thank you. Thank you both for your information.
Yeah. Great questions.
Yeah. Good question.
All right. Well, if there's no more at this time, I think Kevin will take us through some of the specifics of the portfolio and maybe elaborate on some of the numbers I already hit on.
Yeah, absolutely. Yeah, so just to dive in a little bit more, and I zoomed in here. Hopefully, you can see the numbers a little bit better. I mean, so yeah, like Aaron said, it was a fantastic year. So I mean, you can see that there, 18.5% return in dollar terms, 6.6 million of a dollar gain. It is interesting to note that the last 3 months of 2020 were really great. Which is interesting because we did have a little bit of a period there in early fall where, we did have a little bit of a sell-off. But then after that, I mean, things just rallied. And so for the portfolio specifically, last 3 months of the year, you gained about 5.6 million, which equates to about 15.2%. So a lot of that return was built into that last 3 month time period, which is kind of interesting. Last 3 years, last 5 and last 10, I mean, the returns, again, double digit, over 12%. Last 5 years, we've been averaging 14%. And, Aaron alluded to this too, but I think it's just important to note that, these percentages are one thing, but, when you're talking about 12, 14% on a $33 million portfolio, the dollar gain that you've seen has just been incredible. Last 3 years, 12.5, last 5, 21.5. And then last 10, about 31 million. And then of course, since inception, like Aaron was referencing, we've been averaging 8.4%, which equates to about a $37 million dollar gain in dollar terms. So really excellent performance there. Just for perspective, you can see how the major market indexes have done, and really, not only have you, either outperformed the S&P or been very close to it over all these time periods. This global benchmark here, this MSCI All Country, and that's 100% equities, 50% U.S. stock, 50% approximately international. You've outperformed that pretty handily as well over every single time period. So, yeah, I mean, the performance on an absolute and relative basis have just been, really fantastic. So we've been very pleased with the performance overall. And again, this just shows the asset allocation high level. So we do have a little bit of cash in the account, 3%, which we can look to invest depending on what the group would like to do. But again, overall, 96% equities, which I'll go through a little bit more in detail here in a moment. And then this chart, like we always like to go through, just shows how the portfolio has done, since inception, and then also versus any cash inflows or outflows. So again, the gray line represents if, you just left the cash in the account and either added money to it or distributed from it, but left it uninvested. So you can see the blue line, which is the actual return since you have been invested, just how much separation we've seen, which is a good thing, just over the years. And really since 2008, you've just seen tremendous growth over time, which has led to that, $30+ million return since then. So just really good to see. This is exactly what we want to see with any client we work with is, regardless of what the balance is, if you had left it in cash, the actual gain from the market has been, really incredible. So a little bit of redundant information on this page, but just again, like we always like to cover, is just this portfolio performance since inception. And this is your cumulative or all-in return. We talked about average return per year, but you can see here, again, since 2008, just the explosive growth we've seen since that over the last 12 years. And, on a percentage basis, it's kind of eye-popping to look at, but, it's over about 500% return since the portfolio started to be invested since inception. So, really, again, I can't say it enough, but the returns have been just, really fantastic, which I know helps the firemen's pension quite a bit. So we've been pleased with that. Just to dig into the asset allocation a little bit more, and I know we've talked about this before, we're pretty much in line with the policy. We do have some in cash. So I mentioned 3% before, and if you can see, it's a little small probably on your screen, but we've got about 1.2 million in cash. So we could look to invest that. A lot of that is from dividends that hit the account at the end of the year. So a lot of those funds that Aaron referenced did very well, paid out sizable capital gain dividends. So that's what led to this run up in cash. So that's just something for the group to consider is, we can look to invest that as part of the equity allocation that we have. Or in the past, I know there's been the decision to move that over to the fixed income allocation to invest as well. So that's something we can discuss, towards the end. In terms of the equity allocation specifically, we're still about 86% in the US portion. And then the international portion now stands at 14%, which of course, as Aaron referenced, international has done really well here lately. And so you have seen that allocation jump up a little bit since we last spoke. And a lot of that is just due to capital appreciation within all of the international funds that you are invested in. And then just to look at, going back to the returns, more on a relative basis again, you can see the U.S. equity allocation, which makes up about 83% of the portfolio versus the S&P 500. Pretty good outperformance, year to date, almost 1% higher. Last 3 months, over 2% higher. And then, pretty much in line for the most part over, last 3, 5, and 10. And of course, we're still outperforming it about 70 basis points higher on an average return basis since inception. And of course, US has done very well, but just to spend a little bit of time on international too, last 3 months, all funds have outperformed by, over 4%, which is really fantastic there. Year to date, 13.9% versus 10.6 for the benchmark. So it's really nice to see those international investments start to perform well. I know we added more last year because valuations were attractive. And so we're starting to see that pay off a little bit here recently. Still on a long-term basis, US has continued to outperform, but we might see that divergence a little bit here moving forward. And then lastly, not a large allocation, but the international fixed income component returned about 5% year to date, which has been a pretty decent investment for the portfolio as well, even though it's not a substantial portion. So. And then from a risk return perspective, we've had in 2020, there was a decent amount of volatility, particularly in, Q1, Q2, but that's dissipated a little bit. But, you can see the portfolio for Urbana Fire here, which is this blue square. And then you compare that to the S&P, which is the green circle here. So we're still, from a risk return perspective, more efficient. Meaning that for a given level of risk, we're actually returning more, which is good. So volatility is relatively the same, maybe a little bit higher volatility that we've experienced in the portfolio since inception. However, again, still getting more return. And so that's what we do want to see. This intersecting point is a 60% equity, 40% fixed income portfolio, just for that perspective. But again, given that you are 85% US and 100% equities overall, this is really good from a risk return perspective when you compare that to these benchmarks as well. I'm going to pause there for a moment. Any questions from the group?
Kevin, this is Brian. I have one question for you.
Sure.
You talked about the cash available that we have, and just from your professional standpoint, do you think it's wise to look at the, I'm sorry, you mentioned it earlier, the fixed income portfolio, considering second quarter, we're going to see a lot of things lifted, such as the rent moratorium, the extended unemployment, and there probably will be quite a bit of volatility at second quarter. Do you think it would be pretty wise to maybe stay in the fixed income side, or what's your guys' impression on that, or is there any speculation so far on that?
Sure. Yeah, and I'll let Aaron take. I think we're going to agree here, but I'll let him add some commentary first.
Yeah, probably as we look across the board at everything you own, the most attractive area right now as we sit today is probably the international stocks. Like I said before, the valuations look fairly attractive. One other thing that may give those a boost, and we've kind of seen this trend happening over the last few months, is the US dollar has actually been weakening against a lot of these other foreign currencies. And when that happens, that just kind of adds an extra boost to the returns from those international stocks. And we think that's a trend that could continue as well, given the large amount of stimulus we put in place, the large deficits we're running. That could very easily weigh on the dollar here in the near future. So, yeah, if we had to pick out one thing that we kind of thought was the most attractive right now, it would be that area. Now, obviously, you guys have the policy constraints, and I'm guessing with the big run-up in equities we had, I'm guessing you're bumping up against your threshold there, and you may be forced to buy bonds just because to get you back in within your policy weightings. I'm just guessing on that, but I think it might be a good guess at this point. So, Kevin, I don't know if you got anything to add in addition to that.
Yep. No, I mean, totally 100% agree. And I think maybe that's just a good question for, where that fixed income portion stands, if Ron has that information, because I mean, some of it, we're kind of restricted a little bit of what you can do. But like Aaron said, I think, international is a good spot to consider, if we can add more to equity, and we're not off balance from that policy target that we have to meet. And then like Aaron was saying before, I mean, fixed income, the outlook there is not the best, just given where things are with interest rates and where things are going to stay. So, yeah, I mean, in an ideal world, if you could put it to work, it would be in the equity space and the international component specifically. But again, it just depends on, what we need to do to meet that policy requirement benchmark.
Okay, perfect. Thank you. It'll give a little bit more info with the group discussion. I appreciate it.
Sure, absolutely. So jumping ahead a little bit to the fixed income, since we were just talking there, you know, and again, 2020, like Aaron said, was a really good year for fixed income. I mean, kind of equity-like returns. We don't normally see, you know, a 7% return in bonds. So we did see a nice run up just from a appreciation and price component. So, you know, year to date, the dollar gain was about 317,000 in the bonds that you do own, equating to that 7%. And, you know, since we've been, and again, this is more of a corporate bond focused strategy, and corporates have done fairly well over the last several years. So you can see that reflected in the last five, and then since inception returns, where we've averaged about 5.5% return over the last 3 years, 4.6% over the last 5, and then about 4% since 2014. So just overall, really good performance in the fixed income side. But again, just to reiterate, we don't expect to see this moving forward, especially just, again, given where interest rates are, as Aaron referenced, you know, the 10-year treasury is starting to go up as well. You know, and for fixed income, just in general, again, we've talked about this before, is that when interest rates go up, bond prices tend to go down. And you would see that reflected here in these numbers, because also a reminder, this is just the price appreciation of the fixed income. This does not represent the coupon rate that's associated with the bonds. So that's an important component, because if you look at what a projected return of what a fixed income or bond investment is, it really is, you know, what is the coupon that bond is paying specifically. So just wanted to mention that too, because this does not mean that we're getting a 7% yield on the bonds. It really just means that's how much the prices have gone up of the fixed income investments that you're in, if that makes sense. Okay. And, you know, again, just in terms of appreciation, specifically for the fixed income, since inception, so since 2014, again, this kind of looks like an equity chart, but we'll take it, because again, that means that your bonds are more valuable, more attractive in the secondary market because of the type of bonds that we have purchased for you. So in terms of just the appreciation, almost 30% since 2014, which again, for fixed income, is a very good return. So we do like to see this. It does give you a little bit of flexibility. It is good to see the values creep up, even though, again, we're not you know, attempting to sell out of bonds. What we are trying to do is just hold the bonds to maturity. But if we needed to, the good thing is that we probably would experience a gain depending on what bond we would sell. So just wanted to mention that as well. And then just in terms of the comparison versus the benchmark, and again, Aaron referenced this already, but just looking at not, you know, excluding the money market component, which there is a little bit of cash in here too, which we're working on putting some of this money to work as well. So it's about 81,000 there. But just looking at the 4.7 million that is invested in fixed income, you know, we're exceeding the benchmark there as well, about 90 basis points higher for the year-to-date return, 7.3 versus 6.4 for the index. And then very similar story here for the last 3 years, last 5 years, and then since inception. And again, this is a corporate bond focused strategy, so it is a little bit more heavy there versus what the index is. But again, very good return both on an absolute and relative basis overall. And then looking at the risk reward efficiency for the fixed income portfolio. So again, this is a little bit different because it's 100% bonds. But even with that said, you know, we like to generally be above this efficiency line. That's what this is, which again, this intersecting point is a 60% equity, 40% bond portfolio. So anytime we can be above this line, regardless of what type of portfolio we have, you know, that's what we want to see and like to see. So the portfolio for Urbana Fire is right here, this blue square. This gold star is a municipal bond index, whereas the index that we compare it to is the Barclays Capital Intermediate Government Credit, which you can see here. So no surprise, since we are more in the corporate bond space within the portfolio, tends to be a little bit more volatile than the overall Intermediate Government Credit Index. So while we are taking on a little bit more volatility, we're also getting compensated for it in the portfolio, which is exactly what you would want to see. So overall, pretty solid numbers from a risk return perspective as well. And then just the last thing I'll note here, just on the fixed income specifically, is, this is just kind of an overview of where, which bonds we do own. It shows you that coupon rate that the bonds pay, when they mature. Some have a call feature as well. And then, of course, we have the ratings as well. So, again, we try to focus on quality. So even though we are buying, corporate bonds specifically in this strategy, we are still focusing on investment grade issues. So that's anything above the triple B space. Anything above A is what we want to see as well. And you can see the yields have been pretty solid across the board, but just wanted to give you an overview of what that looks like when you look at all the spectrum of bonds that you do own. It does continue on this page as well, because there is quite a few. So if there are any questions that come up, let us know. We have a fixed income team that helps select these bonds specifically, that works closely with us and with Aaron on his team. So just wanted to mention this as well and see if there was any questions on this or just anything overall on the portfolio.
Awesome. Thank you so much for all of that.
Yeah, absolutely. You're welcome. Yeah, and that's mainly what we wanted to cover. Unless there's a segment that you guys wanted to go back to or have any other questions, there's a lot more detail on the report. If you're curious to look at the Morningstar pages for the specific funds that are owned within the account, those are towards the back, and we're happy to answer any questions on those as well.
Not sure if there's any other questions, but thank you both very much for presenting. Is there any way that I can get an email maybe of the portfolio snapshot that you guys presented? I'm sorry that I could not view it today.
Yeah, absolutely. And we did send it on that distribution list, but I'm not sure if you were on there, but we can resend it again if that would help.
Okay, that'd be great. I can take a look, and I can reach out if I don't have it already. So
perfect.
I appreciate that.
Yeah, happy to.
Perfect. Thank you, guys.
Was that under that Busey, where you had to sign in, that you guys kicked out? I got something from Busey,
Yes.
and I had to log in. I don't have a password and all that. I wasn't quite sure what was going on there.
Yeah, so we use a secure email system anytime we send any client statements or reports. So yeah, you just need to sign into it. If you have any trouble accessing it, though, let us know. We'll try to find a different method.
Okay, I just didn't do it because it was an email, and apparently I work in the state of Kentucky right now. So yeah, fraud's going like crazy. So
sure. Well, it just comes from a general Busey email. It doesn't come from a person. So yeah, it's kind of like, where am I getting this? So yeah, I totally understand.
Yeah.
Perfect.
All right. Well, thanks,
All right,
everyone.
thank you,
Yeah.
guys. Thank you.
Thanks so much. Yeah, have a good weekend. If you have any questions that come up, just feel free to reach out.
All right. Take care, everyone.
Everybody.
Have a good
Take
weekend.
care.
Yep. Bye-bye.
Okay. Did anyone have anything else on investment business? And I can't see if anyone says anything. I do have one thing, if nobody else does. I did receive an update, and that's why I kind of asked Busey as well if they had, as far as the investment consultants from the Firefighters Pension Investment Fund, the board was selected, for those of you that don't know, in December. The December 7th meeting, they chose a few consultants, and as of right now, I understand it, the board selected Marquette Associates to provide non-discretionary investment consulting for the total portfolio. Apparently, they manage 19 of the funds currently, 19 of the total pension funds in the state. And they also selected Ernst & Young LLP for the accounting and audit consultants. So as I find out more information of what that looks like and what their plan are, I will send it out. If you guys are not receiving those updates, I can send those out. I'm not totally sure what the criteria was in which they were selected. I was just told they were selected, so not sure. And I was hoping Busey maybe had a little bit more information or of how they came to the investing side of things. The other question that I had for the group, while we're talking about the investment, we talked a little bit about the cash from the capital gains. So that's probably something we should talk about as far as investment, and maybe put on the agenda for next meeting if everyone agrees to kind of cover that. Have some time to think about our plan. Is Elizabeth on as well?
I'm here, but you're kind of cutting in and out, Brian.
Okay, thank you.
If you're moving the phone kind of away from your face or something.
Okay, I apologize. Is that any better?
Maybe.
No, you went in and out, Brian. It's like you're there, then you're gone. And right now, if you're trying to talk, you're gone.
No, I'm trying to move to a different location. Is that any better?
Seems to be.
Okay, I apologize. Working with some old technology here. That's why I can't zoom in either. The people that know me. Yeah, people that know me are probably chuckling. So what I would like to put on for the agenda for next meeting, and I just want to run that as far as our investments go, is talking about that cash that Aaron and Kevin talked about, and if we have any plans as far as what we're looking to do with that. Elizabeth, I don't know if you have any ideas. I know that Ron's not on right now, but that's something that hopefully by next meeting we can discuss.
Yeah, I'm sure we can discuss at the next meeting. To be honest, I've been dealing with COVID stuff, and I just haven't had time to even really look over the report in great detail. Although I did want to mention about the funds. I don't know. I know some of you probably are familiar with the Illinois Municipal League, and on their website, if you go to their website, which is iml.org, right on that first page, they have a box for the Downstate Police Fund and the Downstate Fire Fund, and they're posting, all the agendas and the meeting information. So if you ever just want to be able to kind of check in and see what's happening, that's a good resource to have.
Okay, that's great. Do you know, does the IML, do they use Marquette and Associates for their investments?
What IML is the Illinois Municipal League. I don't know that they're investing a ton of money, but they represent all the municipalities or many municipalities.
Yeah, I apologize. I meant IMRF.
Oh yeah, I don't know. I don't recall who IMRF is using.
Okay, sorry, I apologize. Okay, so is that all right with everyone if we discuss what we are doing as far as to remain within policy, but then I think direction as far as what our plans were with that overage of the dividends?
Well, I guess we can. I guess you can. I mean, we just still need, you're going to have to keep us up where you're hearing more apparently, because the stuff I saw, they're just going to go in and try to establish some rules. So if you're seeing something up front, are we going to buy and sell out concept because they change it in 1 week? Compared to why are we wasting our time if they're going to snatch it, run with it, and just dump it where they want it to until we got some landmarks, So I don't want to get too far ahead and tell those guys to go shopping for something, and then all of a sudden, a week later, we're dumping it.
Yeah, and
exactly.
I'm gonna say it definitely looks like the firefighters fund is ahead in terms of getting things done versus the police fund. If you look at where they're at and the decisions that they've made. So I think my recollection is the deadline for them to have that done and everything consolidated was the end of calendar 2021. So I mean, it could happen in 3 months. Who knows?
Sure, and that's why I'm asking the question if it's wiser to keep it as cash dividends so that we don't have to worry about making the transfer. So I guess that was my exact question is it safer to actually roll it into a fixed portfolio or to a money market or something of that effect so that we're not losing when we go for the transfer, because we don't know what the transfer looks like. I don't know what the fees would be and all of that, and what the market looks like in that point in time.
Well, and we still don't know if they're going to transfer securities or they're going to have us cash it out and, just send them cash. But I don't think when he's referring to cash, I think all of the cash is in a money market. It's not, it's not just literally, sitting there.
No, sure. Yeah, I would imagine we did. Yes.
Yeah. So, I don't know. I mean, I'd probably say I would just let it sit and we can see if we have better information next time. I mean, we're not, the only thing is that interest rates on this money markets are probably very low right now.
Sure, but it may in the end be a safer option rather than, in distributing it or investing it somewhere else, only to find out, like you said, in 3 months, we're transferring assets and we take a penalty or some form of loss with the transfer if we have to do a cash out or something to that effect, right?
Yeah, I mean, who knows?
Right.
Okay. So we'll just put it on the agenda for next meeting to talk about it, I guess, or at least review the options if more information becomes available. Just leave it open. That's okay.
I will make a motion to approve the First BC quarterly report.
I'll second the motion.
Okay, roll call. Ingold,
Ingold's yes.
Hannon,
Yes.
Schooner,
Yes.
Hoff,
Yes.
and Clapp.
Yes.
Okay, looks like next item on the agenda is the approval of minutes from previous meetings. We had October 30th and November 6th. And I'll apologize for not making the November 6th meeting.
I'll make a motion to approve those minutes.
I'll second the motion.
And roll call. Ingold,
Ingold's yes.
Hannon,
Yes.
Schooner,
Yes.
Hoff,
Yes.
and Clapp.
Yes.
Okay, next item is the approval of the quarterly financial report and pension benefit changes.
So Ron's not here and he would usually do this, but I did have a chance to kind of scan through here. I didn't really notice anything unusual, but of course this is the time of year when we do all the 3% increases for pensioners who qualify for that. So, Brian, do we need to approve those increases, or do we not need to?
Yeah.
Since it's statutory.
You do need to approve them.
Okay. So I'll make a motion to approve the pension increases detailed in our quarterly report.
Ingold will second that.
Okay, roll call. Ingold,
Yes.
Hannon,
Yes.
Schooner,
Yes.
Hoff,
Yes.
and Clapp.
Well, I want mine, so yes.
Okay, next on the agenda is public input. Do we have any public input?
Oh, I think we probably ought to accept the report as well. So.
Oh, I'm sorry. Yeah, I thought that was your.
I'm assuming everybody had a chance to at least look at it. So I'll make a motion to accept the quarterly financial report.
Second.
Okay, roll call. Ingold,
Yes.
Hannon,
Yes.
Schooner,
Yes.
Hoff,
Yes.
and Clapp.
Yes.
Okay, now we can move on to public input if I'm not mistaken. Any public input?
There was none.
There was none. Okay. In unfinished business, we've got the fiduciary liability renewal. February 1st, 2021-22. Elizabeth, this is your section, I believe.
Right, yeah. So last year we paid $3,682 for our fiduciary liability policy. This year they actually quoted us for 2 years. So hold on, I'm trying to open that. I've got too many things going on here on my desktop. So the first year would be oh, wait a minute. This year was, oh, sorry, I'm getting confused by his chart. 3682 was the year that ends at the end of January. 3706 is through, takes us to February 1st, 2022. And I did discuss with them this issue of the consolidation of pension funds, because my thought is when we're no longer making the investment decisions, that should reduce our liability. And we should see a lower premium. And we discussed kind of the status of that and not really knowing the timing. What we agreed and what the broker discussed with Chubb, who's the insuring us on this, was that when that happens, they would be willing to reevaluate. So I think that's the best we can do for now.
Do you mind if I interject real quick on that?
No.
I've sat through a lot of these insurance renewal pitches, and somebody brought like a percentage of breakdown of claim types, and the majority of claims are actually based on the granting of pensions and disabilities, and not so much for the investment section of it. So from our standpoint, not that we're recommending any specific policy or policy type, but to maintain the status quo in renewing your policies to avoid any issues with disability claims, just until we sort everything out going forward.
Yeah, agree. We should renew it, and if I can get us a little decrease in premiums going forward, then I will.
Absolutely. Thank you.
So I'll make a
Thank you.
motion. I'll make a motion to approve the renewal of the fiduciary liability policy at $3,706 annually.
I can second that motion.
Roll call. Ingold,
Yes.
Hannon,
Yes.
Schooner,
Yes.
Hoff,
Yes.
Clapp.
Yeah.
Sorry. Moving on to the new business. We've got new hires. Josh?
Yes. So we had 2 new hires. First was Aldo Gomez, who was a tier 2, and he was hired 11/16 of 20. And then also Osti Shilmadine, and he was also tier 2, January 4th of 21. They both done physicals, and they're both currently working now.
Perfect. I'll make a motion to accept new hires. Aldo Gomez and Osti Shilmadine.
Second.
Okay, roll call. Ingold,
Ingold's yes.
Hannon,
Yes.
Schooner,
Yes.
Hoff,
Yes.
Yeah.
and Clapp.
The clap. Yep.
And next on the agenda, which I believe we've already formally done, the approval of the January benefit increase.
Yeah, my fault. I jumped ahead on that one, but we've done it.
No problem. Our next quarterly meeting looks like April 30th of 2021. Does that work for everyone?
They're trying to get into my retirement stuff. That might not work.
Okay, perfect.
Same time?
Yeah, same time. And then just a quick two housekeeping things real quick if I can. April, I don't know if there's any way, Kay had our expiration dates of our positions on the old agenda. Is there any way to reinstate those? Is that possible for our positions and when they're up for revote? And I'm sorry if it's already been covered.
Sure, I usually put them on the minutes, but yes.
Okay. Okay, I'm sorry. I was thinking they were on the agenda, so they are on the minutes. Okay, thank you. Disregard. And then, Richard, I did touch base with your education, and all you have to do is submit that invoice to get paid out for your class, since that was already approved on an old meeting. And I know the amount was less than which we approved you for.
Okay, thank you.
If there's anything else, we're able to adjourn. Everyone good with that? Make a motion. Anybody want to make a motion to adjourn the meeting?
I'll make the motion. Richard?
Ingold will second.
Okay, roll
thank you
call.
all. Oh, sorry. Go ahead. Yeah, you're probably right. We'll probably get a roll call, I guess.
Ingold,
Yes.
Hannon,
Yes.
Schooner,
Yes.
Hoff,
Yes.
and Clack.
Yeah.
All right. Thank you, everybody.